Yeah.
Think about this for a second. The financial world, it's just packed with really smart people, right? Armies of analysts, crunching numbers constantly.
Absolutely. Day and night.
And the common wisdom says that with all that brain power, everything gets priced in almost instantly. Makes it seem, well, almost impossible for regular folks like you to beat the market consistently.
Does sound pretty discouraging, yeah. But maybe that's not quite the whole picture.
Exactly. What if there are these, like, less crowded corners, overlooked spots where you, the individual investor, could actually find a genuine edge?
That's really the core question we're digging into today. I mean, beating the entire market all the time, that's tough, no doubt, a Herculean task, like you said.
Right.
But the idea that there's still inefficiencies, you mispriced stocks just waiting, that's really compelling. And our goal in this deep dive is basically to give you the mindset to spot them.
Perfect. Forget trying to build complex trading bots or hoping for some magic insider tip. We're actually going back to a classic resource, specifically for individual investors who want to aim for what you might call genius level returns.
We're diving into Joel Greenblatt's book, You Can Be a Stock Market Genius.
That's the one.
And Greenblatt's book, it's really refreshing in the finance world, which can feel pretty overwhelming sometimes.
Definitely.
He specifically set out to find these, quote, secret hiding places for profit.
Mm.
For investors who maybe don't have that Wall Street pedigree, it's all about thinking a bit differently, looking where the crowds aren't looking.
And it's worth pointing out, Greenblatt wasn't just, theorizing from an armchair. He founded Gotham Capital.
A firm with a really remarkable track record.
Yeah. And in the book, he's pretty generous with credit. He mentions his partner Daniel Neer, Robert Goldstein, apparently key insights on companies like Host Marriott there, plus Bob Rosencrantz, Ezra Merkin, Stan Kaplan.
Right, he acknowledges quite a few key people. Even his family, his in-laws get a mention.
Hi.
And those acknowledgments, I think they really show that good investing often builds on collaboration and, real-world analysis. But our mission today is really to pull out the core actionable stuff from Greenblatt's work.
Right.
We want to highlight those surprising insights, the practical strategies that can give you a new lens for looking at investment opportunities.
Okay, so let's start with that big idea, market efficiency. For a lot of people, this theory is basically why they think, why even try.
Exactly. The core concept is, because so many smart people are analyzing stocks all the time, any new information news, data gets baked into the price almost immediately.
So prices move randomly, like a random walk, they call it.
Pretty much like trying to predict the next raindrop in a storm. It makes consistent predictions seem, well, impossible.
So efficient pricing means outperforming is just luck, or maybe not even possible.
That's the fundamental idea.
Yeah.
Now, academics have found a few little wrinkles over the years, right? Like the January effect, where
Yeah.
small stocks sometimes do better early in the year.
Oh, yeah, I've heard of that. And small companies in general, or low PE stocks.
Right. Those effects exist.
Mm.
But as Greenblatt points out, they're often seen as kind of minor, maybe temporary, or just too hard for the average person to really capitalize on once you factor in trading costs and things.
Okay. But Greenblatt pushes back on this, doesn't he? He offers a different angle.
He really does. He argues, okay, maybe the overall market is mostly efficient. Fine.
Mhm.
But these pockets of inefficiency situations where stocks just aren't priced correctly, they absolutely exist. The trick is knowing where to look.
And he has this great analogy for it involving his in-laws.
Yes, it's fantastic. He calls them his closet capitalists. They aren't professional investors at all. They're into art and antiques, regulars at auctions, estate sales.
I love that. So they're not trying to guess the next big thing in, like, antique chairs or something.
Not at all. Their approach is way more grounded. They find something they like, and then they ask one really simple, crucial question.
Which is?
Have similar items sold recently for a lot more money, either at auction or to dealers?
That's surprisingly simple. No complex forecasts about future art trends.
Exactly. No crystal balls needed. They focus purely on hard, recent sales data.
Mm.
Their edge isn't fortune-telling. It's applying their knowledge in these less competitive, less watched places. Auctions, estate sales.
Where you can find these inefficiently priced bargains.
Precisely. So the dusty corner of that antique shop.
Is like the stock market equivalent of, like, unpopular industries, complicated situations.
Yeah, exactly. Less popular, maybe less glamorous parts of the market. The core idea is finding undervalued stuff by looking where most other people, especially the big institutions, aren't concentrating.
Okay, which brings us straight to the idea of doing your own homework. This isn't about chasing tips or making wild bets.
Absolutely not. Greenblatt really hammers this home.
Yeah.
Getting paid well in investing should come from doing the work, the analysis,
Hmm.
not just from taking huge risks. Anyone can
All
gamble.
right.
The skill is understanding the reward versus the actual underlying risk.
And if you do the analysis yourself, you're obviously in the best spot to judge that balance.
That's it. The goal is finding those situations where your own work uncovers potential for, as he puts it, unfair economic returns.
Unfair returns. I like the sound of that.
Yeah, returns that aren't just because you took on more risk, but because you did the digging others didn't.
Okay. Now, this leads to a maybe slightly critical look at how traditional Wall Street analysis works. Sounds like Greenblatt sees some issues there.
He raises some fair points about, well, the system. Think about it. Most analysts aren't paid directly by you, the person reading the report.
Right, they work for brokerage firms or investment banks.
Exactly. And their research often supports the goal of generating trading commissions for their firm. So there's kind of a built-in nudge towards issuing buy recommendations.
Because it's easier to get commissions from buying than selling.
Generally, yes. It's easier to encourage new purchases.
Makes sense. And what about sell ratings? You really don't see many of those.
There's a reason, according to Greenblatt. If an analyst puts out a sell, they risk getting cut off.
Cut off from the company.
Yeah, management, investor relations. They might not want to share information as readily with someone who's negative on their stock. Plus, a sell could hurt the firm's chances of getting future investment banking deals with that company,
Ah, okay. That's why you see softer terms like hold or neutral, maybe.
or price target lowered, things like that.
Hmm.
It's less confrontational than a straight sell.
And beyond just a potential buy bias, there's also this tendency to stick with the herd.
The herd mentality, absolutely. It can be safer for an analyst's career, unfortunately, to be wrong with everyone else than to be the lone wolf who's right or wrong, but stands out.
Discourages independent thinking.
It can, yeah. And another thing, many analysts focus on just one industry, tech, retail, whatever,
Right. Deep knowledge, but narrow.
which means they might recommend the best tech stock, but they aren't necessarily comparing it to, say, a potentially much better opportunity in healthcare or consumer goods because that's outside their lane.
Okay, so this idea of focusing on your own strengths. Greenblatt calls it your net serve. That's an interesting way to put it.
It's a great analogy. He talks about this ping pong player, David Versatsky, who apparently had this killer net serve, just unbeatable if the game was only net serves. But in a real game, exactly, or certainly in, tennis or basketball, that one specific skill isn't nearly as powerful.
So for us as investors, the takeaway is find our specific net serve, our area of expertise or insight.
Precisely. It lines up perfectly with what Warren Buffett says about only swinging at pitches in your sweet spot.
Waiting for the right pitch.
Right. The best investors tend to concentrate their bets where they really know the game, where they feel confident in their analysis, spreading yourself thin across tons of things you only vaguely understand. There's no real edge in that.
Now, that might sound like it clashes a bit with the usual advice about diversification. Don't put all your eggs in one basket.
It does seem to on the surface, but Greenblatt challenges the common idea that just owning, say, 50 or 100 different stocks
Right.
automatically makes you truly diversified in a way that eliminates risk.
It might reduce the impact if one stock totally bombs.
True, it lessens company-specific risk, but it doesn't shield you from the whole market going up or down. That overall market risk is still there.
He even cites some data about the possible range of market returns in any given year, right? And it's pretty wide.
Yeah, the historical data is clear. Even with a super diversified stock portfolio, your annual return could easily swing wildly, maybe between, say, -8% and plus 28% in a typical range. That basic market risk isn't magically gone just because you own more stocks.
So what's his idea of real diversification then?
He suggests thinking broader. Diversify across different types of assets. So stocks, yes, but also maybe cash in the bank, real estate, bonds. Spreading investments across asset classes is maybe a better way to manage overall risk than just diluting a potentially good stock strategy with a bunch of mediocre picks just for the sake of numbers.
Okay, this focus on protection leads to another really key idea. Looking down, not up. Prioritizing the risk of losing money over chasing huge gains. That feels different.
It's a major mindset shift. So much investing focuses on the upside, right? Finding the next 10 bagger.
Yeah, the home run.
But Greenblatt argues, especially when you're finding these inefficiently priced gems, that classic risk-reward trade-off where you have to take more risk to get more return, might not actually apply in the same way.
How so?
Because in these special situations, risk shouldn't just be defined as how much the price bounces around what academics call beta.
Okay, so volatility isn't the main risk. What is?
For Greenblatt, and this echoes Benjamin Graham, the father of value investing, risk is fundamentally the risk of losing money, permanently losing capital. How much a stock price wiggled last year doesn't really tell you how much you could lose going forward if the business stumbles or you overpaid.
Got it. And this is where margin of safety comes in.
Exactly. It's the bedrock.
And he uses his in-laws again here with the art.
Perfect illustration. If they buy that painting for $5,000 and they know similar ones just sold for $10,000,
That $5,000 difference is their cushion.
that's their margin of safety. It's a buffer. Even if their appraisal isn't perfect, even if the market dips a bit, that discount protects them significantly on the downside.
So apply that to stocks.
Buy something for meaningfully less than what you calculate it's reasonably worth. If you do that, Greenblatt says, you drastically limit your potential losses. And often, the upside then just takes care of itself. Priority number one, don't lose money, or at least don't lose much money.
Okay, so all these principles, looking where others aren't, doing homework, focusing on downside, they set the stage for finding specific types of opportunities, these special situations.
Exactly, places where inefficiencies are more likely to occur.
And the first big one he tackles is spinoffs.
Ah, yes, spinoffs, a fantastic hunting ground. Greenblatt cheekily calls them things like discarded corporate refuse.
Huh, sounds appealing.
Well, they might seem unappealing initially, but they often hide real value. Basically, a spinoff is when a parent company separates out a piece of itself, a subsidiary, a division, into a brand new independent company.
And the shares of this new company usually get distributed to the shareholders of the original parent company.
That's the typical way, yes. Sometimes they're sold, but often distributed.
And why would a company do this? Lots of reasons, I guess. Regulatory pressures.
Yep, that's one. Or maybe management wants to focus more sharply on the core business. Sometimes it's about unlocking hidden value. The market might not be appreciating that division properly when it's buried inside a big conglomerate.
Makes sense.
But here's the kicker, the really crucial point Greenblatt makes. As a group, these newly spun off companies tend to outperform the market significantly over time.
Wait, really? The piece that got discarded often does better. That seems backward.
It does, but think about the mechanics. That inefficiency often comes from how the shares are distributed.
Okay.
The new spin-off stock lands in the accounts of people who owned the parent company. They didn't actively choose to invest in this new separate business. They might have bought the parent for totally different reasons.
And they get this stock they didn't necessarily ask for.
Exactly. And what happens, a lot of them just sell it, often without much thought or analysis. It's called indiscriminate selling.
Especially big institutions like index funds.
Perfect example. An S&P 500 index fund might get shares in a small spin-off that doesn't meet its size criteria. They have to sell it, regardless of whether it's a good investment or not.
So forced selling pushes the price down, creating an opportunity.
That's a big part of it. Plus, think about the dynamics inside the new company.
What do you mean?
Often, being spun off unleashes entrepreneurial energy. The management team is now running their own show, directly accountable.
And their incentives probably change too.
Big time. They often get stock options or grants tied directly to the performance of the spin-off, so they're highly motivated to make it succeed.
Right. He also mentions that sometimes spinoffs happen after, like a failed merger or acquisition, kind of a cleanup move.
Yeah, like a bailout for the parent almost, cutting their losses on a deal gone bad. But even that can be a positive signal. It might show the parent's getting serious again about focusing on shareholder value.
Okay, so spinoffs in general can be interesting. Are there signs of exceptionally good spinoff opportunities?
Yes. Greenblatt highlights a few key things to look for. First, situations where the big institutional investors don't want the stock, but for reasons that have nothing to do with the actual quality of the business.
And the Host Marriott example fits this perfectly. Spun off from Marriott International?
Textbook case. When it was announced, the perception was high debt, undesirable real estate assets. Just looked messy.
So institutions were wary from the start.
Many were. Plus, Host Marriott was going to be much smaller than the remaining Marriott International. Too small for some big funds to bother with, even before digging into the details. So you had this institutional disinterest based on initial perception and size, not necessarily on a deep dive into its potential value. Greenblatt saw that as an opportunity created by non-fundamental factors.
Okay, that makes sense. What's the second sign?
Insiders want it, meaning the management team of the new spinoff is heavily invested themselves.
Because their incentives are aligned.
Exactly. If they get a ton of stock options in the new company, a lower starting price is actually good for them, more potential upside. Greenblatt stresses checking the SEC filings, like the Form 10 prospectus for the spinoff and proxy statements. Look at how management is getting paid.
See if they have skin in the game.
Precisely. And with host Marriott, he noted that the Marriott family itself kept a significant stake in the spinoff. That's a powerful signal.
Okay. And the third characteristic
Is when the spinoff basically uncovers a previously hidden investment gem. Maybe it reveals that this separated business is actually dirt cheap on its own metrics.
or it's a fantastic business that was just overshadowed by the parent.
Right? Or maybe it's a situation with a leveraged risk-reward profile. Host Marriott, again, despite the debt and negativity, there was potential for a huge payoff if the property market turned because of that leverage.
So finding these requires digging into the details, reading the business news, the filings.
Absolutely essential. He mentions reading the Wall Street Journal, meticulously going through those SEC documents. That's where you find the clues and do the real analysis. And interestingly, he also notes that sometimes the parent company can become a great investment after spinning something off.
Oh, right, because it's maybe more focused now.
Could be. And he briefly touches on related things like partial spin-offs or rights offerings. They can also create these unique, inefficient situations. But the constant theme is keep an eye on the insiders. What are they doing?
Okay, wow. So just to quickly recap where we are, we've kind of dismantled the idea of a perfectly efficient market, at least in certain corners.
Right. Foundational concept.
We've learned about the mindset thinking like those closet capitalist in-laws looking for value off the beaten path.
Yep. The importance of where you look.
Emphasize doing your own homework, not just following the crowd or relying solely on potentially biased Wall Street research.
Technical independent analysis.
Yeah. Talked about focusing on your net serve, your circle of competence, and rethinking diversification maybe quality over just quantity in stocks.
Concentrating on your best ideas. Yeah.
Yeah.
And broader asset diversification.
And crucially, looking down, not up. Focusing on that downside risk, the margin of safety.
Avoiding the big loss. That's paramount.
And all that led us into the first specific special situation. Greenblatt highlights spinoffs and why they can be such fertile ground.
That's a great wrap-up of the core idea so far. It really all flows together. Find undervalued assets in overlooked places, do the work, protect your capital.
Absolutely. And as we saw with spinoffs, getting those potentially genius returns often boils down to finding spots where the odds are stacked in your favor because you've done the research in these less crowded areas.
And understanding these principles, hopefully equips you, our listener, to start spotting potential opportunities that maybe you wouldn't have noticed before. It addresses that goal of getting useful knowledge efficiently.
Definitely. And while spin-offs were our main example today, it's worth remembering the book explores other really interesting special situations, too.
Oh yeah, things like risk arbitrage, merger securities, bankruptcies, restructurings, lots more hunting grounds.
So plenty more for you to explore if this has piqued your interest.
Absolutely. So maybe a final thought to chew on as you reflect on all this. Now that you're thinking about looking down, not up, where might you start looking for a company today that seems to have a real margin of safety?
Or maybe think about a recent company split or spin-off you heard about. Who might have been the unintended sellers dumping the stock? And what hidden value could have been unlocked there?
Great questions to ponder. Food for thought.
Really valuable stuff. Thanks everyone for taking this deep dive with us today.